Welcome back. We are now less than 10 minutes away from an announcement from the two people you see on your screen, Governor Tiff Macklem of the Bank of Canada and Senior Deputy Governor Carolyn Rogers. The Bank of Canada is widely expected to cut its benchmark interest rate by 50 basis points. Our next guest says lower inflation will allow for further cuts. However, the decline in the Canadian dollar could limit, he believes, the bank's maneuverability. Let's go to Andrew Pyle for more. He's Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Andrew, it's always great to see you. Thanks for making time for us on a busy morning. You expect the bank to cut by 50 basis points. Why do you think that's the right move?
Well, Paul, pleasure being here this morning. The consensus, obviously, is for a 0.5 percentage point cut in the Bank of Canada, which would match the first and more recent cut by the Federal Reserve. I would suggest that there's a little bit of risk this morning that we may see a surprise. In other words, the bank may decide to stick to a 0.25 percentage point agenda for the fourth consecutive time. As you mentioned earlier, Paul, CPI and PPI numbers have been favorable for the bank. Economic growth is definitely weakened. We do have surplus capacity right now in Canada, but we have a weaker Canadian dollar, which can tend to be inflationary at the end of the road when we start looking at inflation months ahead.
Would the Canadian dollar not gather some pretty meaningful strength if the bank only cuts by 0.25 point?
Well, absolutely. The market has been pricing in a 0.5 percentage point cut now for a few weeks, Paul. We see that reflected in the value of the Canadian dollar, which now has moved closer and closer to 72 cents. We've seen it reflected in the bond market, albeit not at the long end of the curve, but we've definitely seen a more aggressive stance by the Bank of Canada priced into the front end of the yield curve in Canada. If we were to see a 25 basis point cut this morning, to your point, Paul, I think you would see the Canadian dollar strengthen. You would also see the front end of the Canadian bond market give up some ground.
I've read notes from a couple of economists today, Warren Lovely at National Bank of Canada and Etienne Bordelot-Lebrec at 9 Point. And both of those gentlemen believe that the text of the Bank of Canada statement could open the door to another 50 basis point rate cut later this year. What do you think of that scenario?
Well, it's definitely possible, Paul, but I think we need to, put a little bit of caution on this. If you look south of the border right now, we had come through a period where most people expected the Federal Reserve could possibly match the 50 basis point rate cut that we saw at the last meeting. That sentiment has really faded away. The state of the U.S. economy right now is stronger than what a lot of economists had predicted back, say, at the beginning part of August when people were talking about recession. We now have a market that's leaning against even a November quarter point rate cut. So I think the Bank of Canada needs to tread carefully here, Paul, regardless of what they do this morning, whether it's 25 basis points or 50 basis points. I think you've got to be careful about leading this market into, an environment of aggressive easing if they simply cannot deliver on that in the fourth quarter of this year. So I think the bank's going to play it pretty cautious. We also have a U.S. election coming up in 2 weeks. We have no clue who's going to win it. And we have no clue what the fiscal policy environment is going to look like in 2025. Lots of reasons for central banks to play it cautiously and not get too aggressive.
Okay, you manage client portfolios for a living, obviously. What are some of the takeaways here for Canadian stocks? And I guess the obvious place to start is the financial services stocks, the bank stocks.
Yeah. I mean, most bank stocks, as you know, Paul, have done extremely well in the last little while. We've seen most interest-sensitive stocks, again, do fairly well. The Toronto stock market as a whole has done well. I would suggest if we see anything that suggests that bond yields may have or may continue to edge higher, we could see some of that momentum fade away. So whether we're talking about financials, telecoms, whether we're looking at utilities, these are areas of the market that could give back some of the ground that we've made in the last little while. On the flip side, though, if we look at the energy market, Paul, where, I think crude oil prices are finding a bottom. We still have extreme tensions in the Middle East. Energy might be one of those areas of the TSX where we could actually see some gains in the next few weeks.
Tell us more about why you think crude is finding a bottom. I think a lot of Canadian investors who are holding the energy stocks would hope you are correct.
Yeah, a few reasons, Paul. I mean, one, as I just mentioned, we're still dealing with a very fluid situation in the Middle East. Most analysts expect that we will see something from Israel with respect to the reaction to Iran. That definitely could put upward pressure on oil. We have a U.S. dollar, which, again, has done extremely well in the last little while. I think the U.S. dollar could start to see a bit of a fade in the next few weeks. That should be supportive for crude oil. And to my earlier point, Paul, if we look at the U.S. economy right now, it's definitely a story of resilience. We expect to see third quarter GDP growth up in the 3% area, which is as far away from recession as I can believe we're going to get. And that strength in the economy, I think, gives us a better demand picture for crude oil. So, I think we're probably in an environment where we could see crude oil push back up to the 80, 85 cent range. To your point, that would be good news for the energy patch on the TSX.